and welcome to Smart Money. On this show, we guide you on how to make the most of your money and build wealth. So let's have a look at what we have on the show for you this week. 2015 may be a volatile year for equity markets, but don't let that deter you from continuing your investments. And as always, we help you with your financial portfolio and queries. Well, year 2015 has been a volatile year for the equity markets, and if one looks at this year's returns, it is in the negative territory. But at the same time, we've seen huge retail inflows into equity mutual funds as one key positive mark for the year 2015. But it's time to once again reiterate what we at Smart Money always say. Don't look at equity markets for short term and make equity your means for wealth creation. Joining us to guide you on how you can do that is Anil Rego, CEO, Right Horizons. Thank you so much, Mr. Rego, for joining us here at Smart Money. And as I point out, for the sake, once again, let's talk about as to why investors need not worry if this year may not look that rosy. What would you like to tell them?
Yes, definitely. You actually need to look at equities in the long run. And so also, if you're looking at equity mutual funds, then the underlying asset is the equities, right? And equities by nature are volatile, so it is something you should expect. And you can actually make volatility your friend. Okay, now how do you do that? SIPs, for example, is one typical example of how you can go about it. You can actually reduce the risk by investing in equities through SIPs and probably through a mutual fund. It's also diversified, so you don't have to get into stock picking, and you have professionals managing it. So it definitely is a good route to use for maybe somebody who's new, just starting out investing into equities. And I think one point is that even though this year we expect to be volatile, the long term definitely, there are a lot of factors which would ensure that equities give you very strong returns. Let's say if you take a 3 to 5 year perspective. And let me also give you some data and statistics to show that. Assuming that even if you had an extremely bad year, what has happened historically is that from a year where equities fell very sharply, you find that a 3-year return has delivered a compounded return of anywhere between 20 to 60%. Okay, and a compounded return means that even a minimum 20% that you've seen in the past actually means that you've got an absolute almost like a 75% return over 3 years. Okay, so definitely you can use volatility, and if you are a disciplined and a systematic investor, you are actually buying in at these times when market is falling. So that's your chance to make that additional return. So I really feel that equity investors and especially equity mutual fund investors through SIPs have nothing to worry about, and volatility can actually help enhance your return.
In fact, sir, we keep on saying that, when the retail investors are looking at equity, they need to look at it for a long-term period. The question then comes is what really constitutes a long-term, and how long-term really can help them beat the risk of volatility in the equity markets?
Yes, studies have shown that, if you look at returns on a 1-year basis and you look at every point of time, let's say every year, you look at it right from the inception of the Sensex, let's say from 1979, okay, and you would find that on a 1-year basis, your probability of loss may be almost like 40% of the time you actually end up losing money, right? But if you extend that period to maybe a 3 years and a 5 years, is where your probability of making a profit enhances very significantly, and your potential for losses or probability of losses actually comes down maybe even to a 20%. So which means that if you are also spreading out your investments, then you are most unlikely that you'll ever make a loss out there. So that's why it's good to be a disciplined investor, and keeping in mind past data. I think a 3 to 5 year is a good time frame. However, equity markets not necessarily follow one set pattern. So it could be that in a certain period of time, like we saw in the recent past, that 5 year became even a 6 years. Okay, so but a minimum 3 to 5 year perspective is definitely what one should look at, And if you're spreading out your investments, then I think that is even okay with volatility as well.
Big benefit really that one looks into equity investment is the power of compounding. Could you, for the interest of the retail investors, explain benefits that one can get through investing in equity and essentially making the most of the power of compounding?
Yeah, let me give you a very simple example of the Sensex itself. And let me just take say a round figure. Even if the index were at say 17,000, right? It means that the index has gone up 170 times, okay? Because an index always starts with 100. So the index has gone up 170 times, okay, since 1979. So even if let's say it went down to a 15,000, you still would be 150 times. So the point I'm making is that in the long run, definitely you will see very good returns, and a key aspect for that actually is compounding. And while you may see volatility in the short run, you will find that even despite all the various issues, there were crisis points for India at some times. We ran out of forex reserves, and the very, very critical times, there were scams. And through all of that, today, you find that you are getting about 170, 180 times your return in the long run, and that is only since, let's say, 1979. So the point I'm making is that long term not only reduces your risk, but also you benefit from the compounding. In fact, many of us, we look at real estate, as an asset which is a long term one, but somehow we associate equities with, say, making quick returns, okay? Actually, equities also follow the same principles of your real estate, and you should just do the same thing. When the real estate market is down, most of us just say, okay, let me just wait out, let me just sleep over it, okay, and you find that then it comes right back. The same thing happens, with equities as well. So if you see real volatile times, you just need to sleep over it, and as long as you've not made some fundamental mistakes, and say you've not been too concentrated, or you've not done too many sectoral bets, okay, if you are diversified, you will definitely not have a problem, and you will see that long-term compounding actually gains you a lot of returns.
We've seen a lot of equity investors, or a lot of investors really coming into the equity markets through the mutual fund route this time around. We've seen some record numbers coming in, and so those who probably would have started their SIPs this year, or those who have started their equity investments this year, what would you like to advise to them?
Yeah, so I think many of them would have come into the market seeing the past returns. Okay, but I think the best thing that has happened is they have come in a lot through mutual funds, firstly, and secondly, they have actually come in through systematic route in a very significant way. And I think that actually shows a lot for how well we've matured over the last few years. The only point that I would like to caution is that sometimes when we see volatility, we suddenly look back at the past returns and say, maybe this is not a good idea to invest in. But the whole point of investing is actually to take advantage of these major falls. And in fact, that's why you are doing the SIP. So if you see volatility, I think you just need to step back, look at it like you're going and paying your EMI for your property, and just let it aside. I'm sure that the same negative market will help you buy in at those low points, and you will see the best returns on those installments.
We've seen over the last few years the mid and the small cap category really giving some stellar returns. Of course, even now as we speak, while the entire equity markets may be looking at a negative return, but marginally in a positive territory is where the mid and small cap category is. They come with their bag of risk, and if investors are getting tempted to make them a part of their portfolio, what is the word of caution that you'd like to give them?
Yes, the point is, you should not get carried away again. It's not good to either have a complete investment in large caps where you miss out, points like these when mid caps do better, and I'm saying vice versa as well. So that the first point is, don't get carried away and go and put all your money into mid caps. The fact that, let's say, mid caps are outperforming doesn't mean that, it will continue to outperform in the future. it's part of a normal market cycle where first you actually see large caps, run up, and then you find mid caps run up. But in case of a larger market fall, you will find that mid caps clearly will underperform and fall much more than large caps. So it's in a volatile year, I think it's good to be a little cautious. If you are doing investments through systematic investments in, let's say, even mid cap fund, that is fine. But I would suggest have a combination of both large cap as well as mid cap funds, and that I think is the best approach to look at. Don't go overboard. And also one key point I would like to highlight is that don't put money lump sum into mid cap funds, especially if you are a new investor into markets. If you are a professional investor and you like to take market calls based on your studies and data, then that is fine. But for most investors, I think you should not be investing in lump sum into mid caps at this point of time.
All right, my last question really to you is to understand what is your view for those investors who are wanting a share of equity markets through investing in through equity mutual funds, but whether active mutual funds, equity mutual funds, or ETF, which is a better option for investors?
Yeah, both have their pluses and minuses. On the positive side, for ETFs, they are a very low cost product and you have lower fund management charges. But if you look at on the other side, if you look at including net of charges, what has the long-term performance been, you'll find that active funds in India have normally done much better than passive funds like ETFs. So I would think that at this point of time, it's better to go ahead with investing in diversified equity mutual funds. Maybe as Indian markets mature, like the US and the UK, etc., at that point of time, probably we may need to relook at this point of view. But I think that right now you're still finding that diversified, actively managed funds are doing much better.
All right. Thank you so much, Mr. Rego, for joining us here in Smart Money and guiding our investors as to how they should look at their equity investment strategy for the coming year. Even if 2015 was volatile, that should not deter them from continuing their investment. Time now for a quick break. To get our expert opinion on your finances, email us or tweet us. Is loss of employment your biggest financial fear? We find out how best you can safeguard yourself from such eventualities. But that comes in after this very short break. Keep watching Smart Money. Email and register your queries at smartmoney@btvn.com.